Hey everyone, and welcome back to the channel. When we talk about making money with our investments, what numbers do you hear? Usually, it's the big ones: 8%, 10%, 12% returns. We love seeing those numbers. But here's the thing, there's a silent partner in every single investment you make, and they always get paid first. That partner is the taxman. The gap between what your portfolio earns and what you actually get to keep in your pocket is one of the biggest factors that will determine your wealth over the long run. You could be the world's best stock picker or the most disciplined index fund investor, but if you're not smart about taxes, you could be losing 20, 30, or even more % of your gains over your lifetime. Now, this isn't about finding shady loopholes or trying to cheat the system. It's about intelligent, completely legal tax planning. It's about making sure the incredible power of compounding interest works for you, not for Uncle Sam. Today, we're going to break down the essential tax rules every investor needs to know. We'll cover the core strategies that can literally save you tens or even hundreds of thousands of dollars over time. It's time to learn how to keep more of what you earn. Let's start with the absolute foundation, understanding the 3 tax buckets. Think of it this way. Not all of your investment profits are treated the same by the IRS. Your money falls into one of 3 buckets, and each one has very different rules. First, we have bucket number 1, ordinary income. This is where you get hit the hardest. This bucket includes things like the interest you earn from your savings accounts, CDIS, and most bonds. It also includes short-term capital gains, which are the profits you make from selling an investment you've held for 1 year or less. All of this income gets added right on top of your salary and is taxed at your regular income tax rate. For many people, that can be as high as 37%. Ouch! Next up is bucket number 2, and this is where smart investors want to be. This is the bucket for qualified dividends and long-term capital gains. It's the preferred bucket for a reason. It includes most dividends from US stocks, as well as profits you make from selling investments you've held for more than 1 year. The tax rates here are way lower, 0%, 15%, or 20%, depending on your income. For the vast majority of investors, the rate is 15%. Your main goal as an investor should be to get as much of your growth as possible into this bucket. And finally, we have bucket number 3, the tax-free and tax-deferred buckets. These are your supercharged accounts. Tax-deferred accounts, like your traditional 401k or IRA, let your money grow year after year without you paying any tax on the gains. You only pay taxes at your ordinary income rate when you start taking the money out in retirement. Then you have tax-free accounts, like a Roth IRA or a Roth 401k. This is the holy grail. Your money grows completely tax-free, and when you take it out in retirement, every single penny is yours to keep, tax-free. Understanding these 3 buckets is step 1. Your mission, should you choose to accept it, is to minimize what goes into that high tax bucket 1 and maximize what you can get into buckets 2 and 3. Okay, so now that we know the buckets, let's talk about the core strategies for your regular, taxable brokerage account, the money you invest outside of retirement plans. These next few tips are absolutely non-negotiable if you're serious about building wealth. Strategy number 1 is the easiest one of all. Embrace the buy and hold discipline. I call it the 1-year rule. Seriously, this is the simplest way to boost your after-tax returns. By just holding on to a winning investment for more than 1 year before you sell it, you magically transform a short-term capital gain, which could be taxed at 37%, into a long-term capital gain, taxed at a much friendlier 15% for most people. The tax savings alone can add 1 or 2% to your real return every single year. In the world of investing, patience is literally profitable. Strategy number 2 is a total game changer, and it's called strategic fund placement or asset location. This simply means putting different types of investments into the accounts where they make the most sense from a tax perspective. For your taxable brokerage accounts, you want to fill them with things like broad market stock index funds or ETFs. Why? Because they are incredibly tax efficient. They rarely spit out big taxable gains, and most of their dividends are qualified, meaning they fall into that lower tax bucket too. Now, for your tax-advantaged accounts, like your IRA or 401k, this is where you should put your less tax-friendly investments. I'm talking about things like bond funds, real estate investment trusts or REITs, and actively managed funds. Bond funds and REITs generate a lot of income that's taxed as ordinary income, that high tax bucket 1, By holding them inside an IRA, you shield that income from taxes every year. Actively managed funds also tend to buy and sell a lot, creating a bunch of short-term gains. It is much better to keep all that messy tax activity contained inside a tax-sheltered account where it can't hurt you. Strategy number 3 is about turning a negative into a positive. It's called tax loss harvesting. When an investment in your taxable account goes down in value, you can sell it and realize that loss. You can then use that loss to cancel out, dollar for dollar, any capital gains you've made elsewhere in your portfolio. If you have more losses than gains, you can use up to $3,000 of that loss to reduce your regular taxable income from your job. And if you still have losses left over, you can carry them forward to use in future years, indefinitely. There is one critical rule here, though. It's called the wash sale rule. You can't sell an investment for a loss and then buy back the exact same thing within 30 days. The IRS doesn't allow that. But you can sell, for example, a total stock market index fund and immediately buy an S&P 500 index fund. They're similar, so you stay invested in the market, but they're not substantially identical, so you can still claim the loss. It's like making lemonade when the market gives you lemons. Alright, let us move on to some more advanced moves and create a simple annual checklist to keep you on track. Strategy number 4 is the mirror image of tax loss harvesting. It's called tax gain harvesting, and it's a powerful tactic that most people don't know about. This works best in years where your income is lower than usual. Maybe you're in early retirement, took a career break, or just had a lower earning year. In those years, you might find yourself in the 0% long-term capital gains tax bracket. Yes, 0%. So, what you can do is intentionally sell some of your winning investments that you've held for over a year. You'll realize the profit, pay zero federal tax on those gains, and then you can immediately buy the exact same investment right back. What this does is it resets your cost basis to a higher price. This means that when you sell it for real many years down the road, your future taxable gain will be much, much smaller. It's a completely legal way to essentially erase a tax bill. Strategy number 5 is something to watch out for as your income grows: the Medicare surtax, also known as the Net Investment Income Tax, or NIIT. If your modified adjusted gross income goes over $200,000 for a single person, or $250,000 if you're married, your investment income can get hit with an extra 3.8% tax. So, let's put this all together into a quick annual checklist. Every December, take a look at your portfolio. Are there any losing positions you can sell for tax loss harvesting? Also, check your income for the year. Is it a low-income year where you could do some tax gain harvesting at that 0% rate? Double-check your asset location. Are your bond funds still tucked away in your IRA? And the big one, be careful about buying a mutual fund in a taxable account late in the year, especially in December. They often pay out their annual capital gains distributions then, and you could get hit with a tax bill for gains you didn't even participate in. And of course, the most important thing, have you maxed out your contributions to your Roth IRA, your 401k, and your HSA? If you have ones, fill up that tax advantage space first. Let's do a quick recap. First, know your tax buckets. Always favor long-term gains and qualified dividends over short-term gains and interest income. Second, use those core strategies. Hold investments for over a year, put them in the right accounts, and harvest your losses. Third, think about the advanced stuff. Use low-income years to harvest gains, and be mindful of those surtaxes and contribution limits. Tax-efficient investing isn't really about making more money. It's about keeping more of the money you've already made. Just improving your after-tax return by 1 or 2% each year, when compounded over 20 or 30 years, can be the difference between a good retirement and an absolutely incredible one. So be a great investor, but more importantly, be a great owner of what you've invested in. Thanks so much for watching. If you found this helpful, hit that like button and subscribe for more content to help you build wealth. See you in the next one.